Hey, kings and queens, Sandra Fenwick here, your mortgage consultant, coming on today to talk to you about appraisals. I remember in my last Lunch and Learn, I was saying that I was going to go into detail about the appraisal process and what the appraisal means. Now, the appraisal is almost the most important part of the loan process because the appraisal tells the value of the home and it protects the buyers and the sellers. Now, I'm going to go through a presentation that I made, but all homes need to be appraised to figure out, well, anything of value need to be appraised. If you have some jewelry that you want to know how much it's worth, then you take it to a jeweler and they look at it and they tell you how much it's worth. If you have a car, you can take it to CarMax and they'll go over their car and the condition of the car and they'll tell you how much it's worth. So that is the same exact thing that we do to determine how much your home or your land is worth. Now, appraisals are done on if you're buying your primary residence, if you're buying your investment property, and if you're buying a commercial property, if you're buying land, it's always appraised so the bank could be protected on the amount of money that they lend you. So I'm going to get into the presentation. All right. So I'm gonna go back to the beginning. Sorry, I don't know how I ended up on slide 5, but we're gonna start over. Boom. So what I need you guys to do, if you want to download my business card, please scan this. So you can take a screenshot of this screen so you can scan this QR code and then you can save my contact information. It will have all of my social medias, my contact information, email, and how you start the application. So you can go ahead and take a screenshot of this and I'll put it back on the screen if just in case you don't catch it. So today we're talking about the importance of a home appraisal. All right. What is an appraisal? An appraisal is a professional, unbiased estimate of a home's fair market value. So what we need to do is figure out what the fair market value is. And there are several factors that they use to determine the value of your home. And we'll get into that a little bit later. But that's what an appraisal is. It is required by lenders to assess the loan risk. So if they're selling this home for $700,000, the lender is going to appraise it to make sure that it's really worth $700,000 before they loan you the money to purchase it. So the lender requires it to assess the loan risk, and it's conducted by a certified licensed appraiser. Appraisers take an extensive class. They are tested for their licenses, and they have to do a certain number of hours. What do you call it? What's the word I'm looking for? It's almost like an internship where they shadow an appraiser who's been in the business for years, and they have to go through all of that before they can appraise your home to make sure that they have the proper knowledge to be able to do so. All right. Why does appraisals matter? It protects the lender from overlending. In that example, if you are trying to buy this home for $700,000, but it's only worth $650, if the bank was to lend you $700,000, then they're overlending. Okay. It supports the fair market price for buyers and sellers. So for the buyers, it protects you from overpaying for a house. So why would you pay $700,000 for a house that's only worth $650? Then you're going into the house with negative equity. And for sellers, it helps you not get undercut. So if you know your house is worth $700,000 and you're selling it for $600,000, then you could get undercut that way. So it's always best to do the appraisal to know what your house is worth. And it determines your refinance eligibility and the equity position you have in your home. So when you're going to refinance, we look at your loan to value, and the value part is done by the appraiser and the appraisal report. So if you need to get $100,000 out your house and it's only worth $80,000, then that's not going to work. So the bank will require you to get an appraisal to let you know what your equity position is and to cover your refinance. How is the home value calculated? So they do it several ways. They do a sales comparison. So they look at homes in your area that's close to you, like within a mile, 2 miles. It's not very far. They look at homes in your area because the area and everything determines what your house is worth. So they look at homes that are comparable to yours. They have similar upgrades. They have similar square feet. They have similar land on the home, and they see what that house is sold for, and those are called comps. So if you say, if you hear a realtor say, let me run the comps on this property, then that's what it is, a comparable sale. And then they do the cost approach. They look at replacement costs minus depreciation. So how much would it cost if this house burnt down to the ground to replace, and how much has it depreciated over the years? And then you can determine that by, the amount of upgrades to it. How much have you done to it? Did you just replace the roof? It has the house depreciated a lot. So the income approach, they look for rental income potential for investment properties. So when you are purchasing an investment, the appraisal costs a little bit more because they're also doing a rental comparison and the appraiser will determine how much rent you could possibly get for that property. So those are the different types of ways that they calculate the value of the house. How lenders use appraisals. So they use it to determine a loan amount, right? So that's the LTV that you always hear me talking about, the loan to value. So how much is the house worth versus how much we're going to lend you? So when you're a first-time home buyer, if you're using a conventional loan, then you are required to put down 3% of the home value. So, and then the bank will lend you 97% of the home value. So that's how we can determine how much we're going to lend you on this house. So let's say they want to sell the house for $700,000, but it's only worth $680,000. The bank is only going to lend you 97% of that $680,000. So if you still want to buy it for $700,000, you can, but you're going to have to come up with that additional $20,000. However, when that happens, it's usually some negotiations involved and some price changes involved. So it influences the interest rate and the terms. So the value of the home influences. That's another determining factor on what interest rate you're going to get. The interest rate is not always just determined by your credit score. It's determined by your loan amount, your credit score, the area it's in, the county. It's a lot of things involved in determining what your interest rate is going to be. And the appraisal is a big part of that. And it's used for refinancing, selling, and disputing property taxes. So again, in my example before, if you're refinancing, the bank needs to know how much that house is worth, to know how much equity is in it, to know how much money to lend you. And if you're selling the home, some people get pre-sale appraisal done, so they can know what the proper amount to price their house at. And the county or state you're in, when they're determining how much you're going to pay for your property taxes, they do a valuation of the property and of the land. And then the property taxes are determined because of that. So if you're disputing the amount of taxes that you're paying, then you can use your appraisal report to do that. All right. Types of appraisals by loans. Now, it depends on what loan program you're going into to determine the type of appraisal that you're going to do on the property. So, for example, because we're brokers, we have access to hundreds of different banks, right? So we look at your loan file and we determine which bank we're going to use to get your loan done. So if you're going into a loan with the FHA loan, right? FHA does its own type of appraisal, but all of a sudden you may be in a condo that may not take FHA, and we have to flip your loan over to a conventional loan. Then we have to see if that appraisal can be converted to a conventional appraisal. So the types of appraisal, conventional that focuses on market value and fewer conditions are required. FHA meets the HUD safety and condition standards. So FHA is a government loan, right? It's given to you by the federal government, or it's backed by the federal government. It's insured by the federal government. So they're going to look at, the appraiser is going to look at the house not only for the market value and the condition, and if it's deteriorated or whatever, they're going to look at also, are there any safety hazards in this house? Is there anything in this house that, if you, like someone had a broken sump pump in their house and the appraiser didn't pass the appraisal, they required that to be fixed before they passed the appraisal. Someone had some wires down in the back that could possibly be a trip hazard, or it could possibly be disconnected from the house and it could shock somebody. So that's a safety hazard. So the FHA, the appraiser is going to look at this appraisal differently if you're getting an FHA loan. The VA includes Tidewater and ROV process, strict military standards. So they're going to look at that appraisal differently. The USDA is looking at it and seeing, is it eligible for USDA? Does it have a rural eligibility on it? And it's focused on health and safety as well, because USDA comes from the government. They want to make sure people are safe. And if it's an investment appraisal, then it's based on the rental income and the resale potential of the home. So again, if you're buying a house to buy and sell using, let's say, a DSCR loan, they're going to run the rental comps on it, and then the bank is going to go by what's on that appraisal on what rent you can get for that particular property. So there are several different types of loans, and that's how they look at the appraisal and how they're going to determine the value of the house. So go back to that example. Let's say we went to one bank, or you went to a bank and they couldn't get your loan done. The house has already been appraised. You've paid for the appraisal, but you have to go to another bank. You came to me for a second opinion. And I say, oh yeah, we can get this done, but only if we do a conventional loan. Then we have to either see if that appraisal can be converted to a conventional appraisal, or you may have to pay for a new appraisal and get a conventional style appraisal done. Does that make sense? Okay. What does appraisal is subject to mean? So the subject to, when we're waiting for the appraisal to be done, so the appraiser goes there, does everything they need to do in the house, and then they go home or go to their office and they write an appraisal report. In this appraisal report, they're going to say this house value is $700,000 as is, or they're going to say this home is worth $700,000 subject to. Subject to indicates the conditions needing corrections. So they're going to indicate if it needs repairs required for safety issues, if it's an inspection pending, if they may say, hey, it's because of the structure of the house, it's deteriorating down here. We're going to require inspection done, a termite inspection done, or a house is kind of leaning this way and it looked like it may be some structural damage. We need you to do an appraisal. And then we have a final lender review. So if your home is appraised and in that report it said this home will be worth $700,000 subject to the chip paint being, I've had several reasons why I came back subject to. Again, the sump pump wasn't working. I've had chip paint in the rooms that's older, that could be possibly lead paint because it's an old house. The appraisal said you need to scrape that paint down, repaint the walls. I've had it come back subject to because there were There were bars on the windows that didn't easily open up. So that's a safety hazard. So the bars had to be removed or they had to be replaced with something that could easily be opened just in case there's a fire and you need to get out that window. Um, I've had people, I've had it being subject to because a shutter was hanging off the window and it wasn't properly connected. So they had to replace the shutters. I've had someone, an appraiser, require a dry basement certificate because it appears that there was water damage in the basement. So all of those are reasons the appraisal will come back subject to. An appraisal is different from a home inspection. The home inspector goes and looks at the condition of everything in the house. Is the water heating up right? Is the AC heating down, cooling down? Is the um, is there any structural damage? Are the appliances working properly? Is the HVAC system up to date? All of those things the home inspector gets into. The appraiser is looking at it with a different eye. But depending on what the type of loan you're getting, the appraiser is also looking at any hazards that could be hazardous to you. If you buy this home and that shutter was to fall on your head and injure you seriously, that would be an issue. So the appraiser is going to come back and say, hey, it's worth this subject to these things being done. So when they come back to us, we let the agents know, the real estate agents know, and they negotiate some type of terms. The seller's going to pay for this. We're going to get it done, whatever. The seller is usually responsible for these things because this is still your house. The buyer does not own it yet. So the buyer should not be responsible for fixing things in your house. Because what happens if this loan doesn't go through, then the buyer has come out of pocket and paid for something for a house that they don't own. So the negotiations are done usually with the agents. And then once the work is completed, then the agent come back to me, Sandra, we're done. And we're going to schedule an appraisal reinspection. So the appraiser is going to go back out to that house. They're going to check and make sure everything is done up to their standards. And then they're going to go home and rewrite a different report. And they're going to say, okay, now the house is worth this value as is. And then we're going to submit that appraisal report to the underwriter, and it's going to get a final lender review. And the underwriter is going to verify everything, and then they're going to write it off. This appraisal report is extensive. It's probably about 30, 40 pages. It had pictures of everything. So if something comes back subject to, there's going to be a picture of it in that appraisal report so you can know and you can see as the buyer that this is the issue and this is what it is. Once they rewrite the report after they sign off on the repairs, then they're going to give you an updated report with updated pictures to show you that that work has been completed. So this protects the buyer as well to make sure you're getting a good structurally sound home, a house that's free from termites, a house that's free from water damage and leakage. That's what it means to get a subject to appraisal. Appraisal contingencies and gaps. And this is more done by the real estate agent when they're doing your initial contract. They put contingencies in place just in case something comes back on the appraisal. If the appraisal comes back lower than what this is, then you agree to lower the price or whatever you agree to do, split the cost or whatever. They negotiate that. So contingencies let the buyer renegotiate or cancel if an appraisal is low. If there's a gap, if the sale price exceeds appraised value, buyer may pay the difference. It's a negotiation tool in competitive markets. Again, I'm not going to speak too much about the appraisal contingencies and the gaps because, again, that is the real estate agent's job. But if that contingency needs to be written in the contract when you first go to sale, they give you a certain amount of time to get the appraisal done, and they put in contingencies just in case that appraisal comes back subject to or it comes back low. If you're trying to sell it for 700,000 and it only appraises for 650, then we got to go back to the drawing board and see what we're going to do about this gap in what you're trying to sell it for and what it's worth. All right. Different talking points I wanted to come out with, and then the differences between the different appraisal types. And I think that was a great slide because it did break down the differences between determining what type of loan you're going to get and determining what the what the appraiser is going to look for and what could be reasons why it will come back subject to. So VA does a different appraisal. So if you get in and you get a VA loan, but you come back and say, oh, with my VA loan, I only have a certain amount of entitlement. So in order to buy this house, because it's 800,000 and my entitlement won't cover that, then I want to go ahead and switch over to a conventional loan. Then you qualify for the conventional loan, but the loan parameters change and the appraisal changes. So we may have to get that appraisal redone, or the report needs to be readjusted by the same appraiser. There are several things that may need to be done in order to make that happen. So as a owner of the home, if you're going to refinance and you get a really low appraisal and you know for a fact that your house is not worth that, then you can dispute that appraisal. We would have to put in a dispute with the AMC. That happened to me with one of my clients who lives in DC. I had refinanced her 1 year, and then the next year she wanted to refinance and take the money out of the house. So we had to do a dispute, right? So you have to find comparables in that area of houses just like yours, similar to yours, same square feet, that sold, and then you submit that to the AMC. And then you also, like with this person, the year before that, her home appraised for 780,000. But the next year, where all of the land value or the home values had appreciated, the home appraised for 750. So it even appraised for lower. They had did upgrades to the house. The house had been changed. Like it wasn't in really bad, poor condition. So they said, wait a minute, we want to dispute this appraisal. And we did just that. Another appraiser, either the same appraiser will come out and redo the appraisal, or another appraiser will come out and redo the appraisal. The importance of accurate comparables or comps. So the house has to be, appraiser is going to do his own comparables or her own comparables and put those in a report. So you can see in that 30 to 40 page document what homes they use to compare your house to. So it's very important for them to pick homes that's similar to yours. So, and what's the role of the appraiser in an investment strategy? If you're buying a home, especially to fix and flip, it is extremely important to run proper comparables based upon the work that you're going to do to that house, because you want to be able to determine how much your house is going to be worth. They're in that same neighborhood. They're within a half a mile or a mile away, and they're similar to your home. They have the similar upgrades to the upgrades you're going to do to this house. They have a pool in the back, and you're going to put a pool in the back. They have this amount of square footage, and this is the amount of square footage this house has. So the role of the appraisal, when they first do the appraisal, they're going to look at the scope of work and what you plan to do to that house. And then they're going to look at comparables close to what your scope of work says. And they're going to say, based upon the scope of work and what you're trying to do to this house, based upon other homes in the area, based upon the size of the house and the changes you're going to make to this house, this is what this house is worth. Now, as they're going through the renovation process, at the end of that process, the appraiser is going to come back out and look at the house to make sure everything that was on that scope of work is done. And then they're going to write you a full appraisal on what the value is to that house. So, similarly to buying a investment property that you're going to rent out, the investor is going to look at the condition of the house and tell you what the value of the house is now, as of this moment of what you're doing to the house. But they're also going to tell you, based upon this, most homes in this condition, this size, this amount of bedrooms, get a rent of $2,400 a month, between $2,400 and $2,700. That is going to be in that report, and that is what the lender is going to use to determine if they're going to lend you the money based upon the rents you're going to receive on this property. All right, in summary, appraisals are essential for smart lending and smart buying and smart selling. It's a lot of times it's good to get a pre-sale appraisal to know what your house is worth, so you can know what to put your house on the market for. But agents, real estate agents, especially the ones that I work with, are very good at determining the value of your house. So, they are good at saying, okay, based upon the comparables, this is what you can sell your house for. So it's not required to do a pre-sale appraisal, but it's a good thing to do. But when you're lending, you're not going to, if you're on a pawn shop and somebody bring a ring to you and they ask you for $100 for that ring, but it's only worth $30, then you're losing out money. You're over lending. You don't want to do that. And when you're buying, you're going to pay for an appraisal. You're going to have that report to know that this house that I'm buying is really worth this amount. Know what type of appraisal your loan requires. FHA loan requires an FHA appraisal. And when you get that report, it's going to say on the first page, this is an FHA appraisal. So know that you're getting the proper loan type. Appraisal type. Understand what can impact the value of your house. Now, when you're in certain neighborhoods, hey, listen, an old friend of mine would be like, hey, they putting a Chick-fil-A up the street. They putting a Target down the street. Now my home value going to go up. If there's certain improvements being done to the neighborhood and great things are happening, then that could impact the value of your home. There's bad things happening and there's a bunch of dilapidated houses around and, it's falling apart. That's why you want to be involved with your city councilmen and your congressmen and your mayors and stuff to make sure that they're keeping your neighborhood up so your value can continue to increase. So understand what can impact the value. Understand that if that roof is going bad and, and it's falling apart, then you need to get that changed. If you had a flood, you need to get that changed because that impacts the value of your house. Be prepared to respond to the appraisal outcomes. 90% of the time, the appraiser, you read through that report, it is what it is. The appraiser is doing its job, But if this is your home and you're getting it appraised and it's worth what they're telling you it's worth, be prepared to respond to that. And I can definitely help you with that on my end. I'm sorry, I'm going over time. If you have any questions, please put them in the comments. Feel free to inbox me. Feel free to call me at that number. Please take a screenshot of that. Or we can go back to the first slide. And you can take a screenshot of my QR code. I hope this helped, guys. Thank you guys for listening and attending. I have to run. I got to get to another meeting. But I love y'all. Y'all have a great day. Y'all stay safe. And please let me know if you need me. 301-965-1155. We'll just have a great day. Bye.